Hi everyone, and welcome to the channel. So you're interested in commercial real estate? Maybe you've had some success in residential single-family homes or small rentals, and you're looking to level up. Maybe you're just getting started and you see the massive potential of bigger properties. Well, you're in the right place. Now we're breaking down the fundamentals, the important stats, and the strategies you need to feel comfortable venturing into the world of commercial real estate investing. It's not just buying a building, it's buying a business. And by the end of this video, you'll have an idea about what that involves. So first things first, what is commercial real estate exactly? Lots of people think it's just anything bigger than a house, and they're not entirely wrong. But the real distinction isn't really size, it's purpose. Commercial real estate is any property that has a business use. We're talking about office buildings, malls, warehouses, medical buildings. You're not accommodating a family. You're accommodating a business. And that is a game changer, because when you're investing in CRE, you're not just a landlord, you're running a business. Your success isn't about what the property on the block sold for, but about the income your property is generating. That shift in mind, from a housing model to a business model, is the biggest leap you need to take. And because it's a bigger game and the deal is more complex, you need a completely different caliber of professional services from day one, like specialized attorneys and environmental inspectors, which we'll get into later. Now, commercial real estate isn't just one thing. It's divided into different categories or asset classes, and you need to know about your options. You can think of those in terms of different sports. They all employ a ball, but the rules and skill sets are entirely different. You've got multifamily, apartment buildings, retail, your local shopping center, hospitality, hotels and resorts, and there's land, just raw, unimproved land. Office space, from small business parks to giant skyscrapers, industrial, warehouses, and logistics facilities that power the economy. Mixed use, which is combining, for instance, apartments over retail stores. And finally, special purpose, which are buildings built for one use, a hospital or a school. Why is this important? Because each of these reacts differently to the economy. Your first meaningful risk management decision is simply which of these lanes to play on. And that brings us to a vital point. Market risk is not one size fits all. Let me give you an example. In 2023 and 2024, when interest rates rose, the office market was hammered. Big city valuations dropped by about 14%. Why? More work from home situations and decreased demand for large office buildings. But right at the same time, the industrial logistics sector, all those warehouses that e-commerce requires, were on fire. Vacancy rates were extremely low, below 4%. Thus, the moral of the story is crystal clear. Your asset class selection is your very first and best line of defense against risk. Industrial or medical facilities industries are likelier to be recession-proof. You don't need to bet everything on a single risky basket, whether that's one industry or one city. All right, let's get to the good stuff, because after you've chosen your asset class, commercial real estate is a flat-out numbers game. Your success lies in the fact that you know 4 basic financial metrics. They tell you what a property is actually worth, how it's performing, and whether a bank is even going to lend you cash for it. Get these down, and you're talking CRE's language. The most important, and the first, is called net operating income, or NOI. It's the heartbeat of your property. You just take your gross operating income, so rent and other income that you collect, and you subtract all of your operating expenses, like property taxes, insurance, utilities, and maintenance. What you have left over is your NOI. And check what's not in this calculation. Your mortgage payment, NOI, presents to you the profitability of the property before you pay your debt. It tells you how profitable the property business is by itself. A high, stable NOI means you have a cash-generating machine. A bad one is a giant red flag. Once you have the NOI, you can use it to calculate the next key statistic, the cap rate, or the cap rate. This is how you come up with a value for a property quickly and compare different offers. The equation is NOI divided by property value. The cap rate is the annual return that you would expect if you bought the property in all cash. Now here's the way you put it. A higher cap rate, like 8% or 9%, means a higher potential return, but it probably comes with more risk. Maybe the building is in an undesirable area or needs serious rehab. A lower cap rate, like 4% or 5%, typically means a safer, more stable investment in a prime area, but your initial cash return will be smaller. It's a risk versus reward straight line. Yeah, but most of us aren't buying properties all cash, right? We're financing them. And that's where the most favorite measure from the lender comes into action, the debt service coverage ratio, or DSCR. This is a biggie. DSCR is your NOI divided by your entire annual mortgage payment. It gives a response to one of the lender's questions. Does the asset make enough money to pay for its own loan? Lenders have an extremely strict requirement here. They almost always require a DSCR of 1.25 or better. What does this mean? It means your income on your property must be 25% higher than your debt payment. That 25% is a cushion for the lender and for you. If vacancies rise or costs surge, you're not going to qualify for the loan if you can't meet this 1.25. The last of the important metrics is all about you, cash on cash return. This one's my favorite because it tells you exactly what you're getting on your real money. You take the annual pre-tax cash flow of the property, so that's the money you have left over after getting rent and paying for all expenses, including your mortgage, and you divide it by the amount of cash you really invested. That's your down payment and all your closing costs. So if you put $100,000 into a deal and it generates $10,000 of cash your first year, your cash-on-cash return is 10%. It's the best representation of your yield that you have when you're using leverage. And it's the way you compare real estate to other investments like the stock market. Now, here's the trick and the risk. These four metrics aren't segregated. They're a chain reaction, and it all starts with the NOI. Your NOI determines your cap rate, which determines the worth of the property. Your NOI determines your DSCR, which determines if you get financing or not. And those two impact your final cash-on-cash return. This is so important, I must give you a strong warning. If you mess up the NOI, if you miscalculate the income or miscalculate the expenses, that one error carries through and propagates throughout the whole calculation. You could overpay for the property on a bad cap rate, and you could fail the lender's 1.25 DSCR standard, blowing up your financing. This is why you must look at least 3 years worth of the property's financial history before you buy. No cutting corners on this one. You see the figures, but how do you start? Beginners usually have 3 main ways into commercial property, each with a very different combination of control, capital committed, and liquidity. Number 1 pathway is direct ownership. That's what it is. You buy and maintain the asset yourself. You have total control but are the most expensive and make the largest time commitment. You're the CEO, and you're the property manager too. Number 2 path is REITs, or real estate investment trusts. It's like buying a stock. You're buying into a company with commercial real estate assets. It's very liquid. You can sell and buy units whenever you want, and you can begin investing for a few dollars. The big downside? The dividends qualify as regular income, so the tax benefits aren't ideal. Pathway 3 is real estate syndications. Here, several investors combine funds to buy a specific large parcel of property. Your minimums are greater, usually from $10,000 up to $100,000, and your funds will be tied up for several years. But as a trade-off, you have access to institutional quality deals, more favorable tax benefits from such items as depreciation, and the potential for much higher returns, often a range of 20% or better per year. So let's make that REIT versus syndications choice nice and straightforward then. It's a typical trade-off. Use a REIT if you need high liquidity and flexibility. If you need to start with minimal funds and have the option to sell out anytime, a REIT is your best friend. The historic average return is decent, around 12 to 13% per year. Then choose a syndication if you have patient capital. This is money that you will never require for 5 to 7 years. If you have a steady, high income and you're looking for more returns, around 20% per year, and you'd prefer those powerful tax write-offs that can offset your other income, then opt for a syndication. You're giving up liquidity for higher potential returns and tax effectiveness. Now let's talk about the largest real-world challenge for most newcomers: financing. A commercial loan is very different from a residential mortgage. The bank's interested in two things: you, the borrower, and the property itself. You're going to need a good credit score, typically above 700. You're going to need low debt-to-income ratio to prove you can keep up with the bills that you currently have. You have to provide a mountain of documentation regarding the property and your financials. And here's a kicker: you may be asked to sign a personal guarantee. That's the one where if the property fails, the lender gets to go after your personal assets. It's a huge risk, particularly if you're new at all this. And now, there are a couple of main types of loans. The standard is a conventional CRE loan. This typically requires a 20% down payment, but they have flexible terms. But there is a hidden gem for a handful of beginners: the SBA 504 loan. This is limited to owner-occupied commercial property. So, if you're a business owner and you're buying a building for your own company to operate out of, you might only need to put down 10%. Bear in mind that strategic advantage. By using the property for your own enterprise, you cut the capital barrier in half. You're at 10% instead of 20%. That makes an enormous difference to many small business entrepreneurs. Now you have your financing lined up. What exactly is the buying process? It's a choreographed dance designed to protect you. It starts with a letter of intent, which is just an informal letter expressing the general understanding. Then you sign a contract and pay a nominal earnest money deposit. This contract must have contingencies to protect you. Then you proceed into the due diligence phase. This is your 30 to 90-day discovery period to confirm that the property is as you think it is. If something feels right, you can just leave and get your deposit back. And finally, if everything is good, you go to closing, where title is conveyed legally, and all the responsibility falls on you. Let me be candid about due diligence. This is not a technicality. This is your all-important armor. It's an exhaustive questioning to reveal any hidden problem that would turn your dream investment into a money pit. You need to have a complete financial review, examining 3 years of expenses and revenues to verify that NOI we spoke about. You need to have a legal and regulatory review, title search, zoning, and for liens and easements, and you just have to have an environmental assessment. You don't want to have a toxic waste cleanup issue. Talking about environmental concerns, this is so crucial it deserves a slide on its own. You absolutely need to do a Phase 1 environmental site assessment. It doesn't matter what else you cut back on. This is a must-do. This report considers the past of the property to identify potential contamination hazards. If Phase 1 identifies red flags, you go into a Phase 2, which consists of actual soil and water sampling. You're searching for lead, asbestos, mold, or underground storage tanks. And here is the one absolutely vital thing in this entire process. When you close on that property, you automatically take on all environmental liabilities, no matter who was responsible for them and when they were caused. If you find a 1970 underground leak tank, you are 100% responsible for the multi-million-dollar cleanup. This is not a threat. This is law. So never ever skip the environmental due diligence. And that leads me to my final word of advice before we get to the end. You can't do it alone. Commercial real estate is too complicated to have one person in charge of it. Don't be the cowboy who tries to do it cheap and loses everything. You need to have an expert CRE broker to obtain the right deals for you. You need a CRE attorney to steer through the knotty contracts and zoning. You need a knowledgeable lender who understands your goals, and you sure as heck need an environmental engineer to perform those Phase 1 and Phase 2 tests. This team is not an expense, it's your policy of insurance. So there's your blueprint to success. First, you learn the financial numbers: NOI, cap rate, DSCR, and cash on cash. These figures tell it all. Second, choose a considered entry point: direct ownership, REITs, or syndications based on your capital, time, and goals. Third, do detailed due diligence without compromises. It's your greatest protection. And fourth, assemble that expert team to guide you. Approach commercial real estate with this kind of analytical rigor. With the proper professional counsel and with a deferential appreciation of both the potential gain as well as the potential risk, that will de-risk your investment in this asset class and set you up for unprecedented long-term success. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.